Greetings, everybody. Welcome to Liberty Call. Today is Thursday, February 16th, 2023. Hope everybody's having a fantastic day out there. Not a great day here in the domestic markets. Most of the day was a struggle to get into the positive, and things really accelerated to the negative here in the last hour or two. So, again, not really surprising. We've had some labor and economic data that came out today, which really didn't make the doves of the Fed feel real good. Most people were hoping that these reports would show that the economy's slowing down, that the jobs numbers look worse, give the Fed an excuse to print, a bunch more money, make the market go way, way, way back up. But I don't see that happening. So anyways, let's go ahead and dive. Well, let me stop. If it's first time watching, please give me some thumbs up, likes, shares, subscribes, follows, all that good crap. I greatly appreciate it. Let's go ahead and dive into the numbers. Dow Jones was down 1.26%, closed at 33,696. It was down over 400 points. S&P 500 was down 1.37%, closed at 4090. NASDAQ was down 1.78, closed at 11,855. Small caps were down 1.06. The VIX was up 11.14% today. It's back up over 20 at 20.27. Canada was down 0.55. Brazil was up 0.43. Mexico up 1.18. Take a hop across the Atlantic. Germany was up 0.18. Same with the UK. France was up 0.89. Euro stocks up 0.4. Netherlands up 0.25%. Let's see. Spain up 0.35. Italy up 1.16. Switzerland down 0.69. And Portugal up 0.77. Russian exchanges both in the red again today. MOEX down 0.58. The RTSI down 0.9. And the overnights in Asia, Japan was up 0.71, Australia up 0.79, New Zealand up 1.16. Chinese markets had a little red in them. The Shanghai was down 0.96, SCSE component down 1.3%, China A50 down 0.2, DJ Shanghai down 1.03, Hang Seng up 0.84, and the Taiwan weighted came in up 0.76. All right, so that's everything for trading day 216. Let's go ahead and jump on over to the recap of today's markets. S&P 500 struggles to shake off Fed hike fears as inflation remains hot. Let me bring up my notes here. S&P 500 slipped today as investors reacted to new data showing ongoing inflation pressure and a tight labor market, stoking further fears about the Federal Reserve's rate hike path. The producer price index rose by 0.7% in January, exceeding economists' forecasts of a 0.4% increase and bringing the year-over-year figure to 6% instead of an expected 5.4%. And the PPI is the producer price index. I personally like this one because it shows what people along the supply chain are charging for the next person along, whether or not it's the end seller or someone else along the way. Prices that producers are, in my opinion, a better reflection of how hot the inflation is in that particular sector or the economy in general. The strong PPI increase arrived just as initial jobless claims unexpectedly fell, suggesting that demand continues to outpace supply in the tight labor market. The data is why policymakers are reiterating their intention to raise rates higher before pausing and then leaving rates in a restrictive territory for quite some time, according to Jefferies. Federal Reserve Bank of St. Louis President James Bullard said further rate hikes could help lock in disinflationary trend during 2023. Growth sectors of the market included consumer discretionary and technology were the worst hit. Tesla gave up gains to trade more than 1% lower after the electric vehicle maker recalled 362,000 EVs equipped with its full self-driving software, which may cause vehicles to act unsafely around intersections. Well, that wouldn't be good because you wouldn't want to be sitting there sleeping behind the wheel and then your car goes crashing through the intersection. You're not supposed to sleep while it's driving. That's a bad thing. You're supposed to keep your hands near the wheel. Anyways, let's see here. On the earnings front, Roku was a standout performer, rising more than 17% after the streaming device maker reported upbeat guidance and a narrower than expected loss in the fourth quarter. Twilio was also a big winner, up 17% after the communications company delivered strong guidance and fourth quarter revenue that topped Wall Street estimates. Cisco Systems reported better than expected second quarter results, and its shares rose more than 4%. that'd be probably fourth quarter results. Virgin Galactic Holdings was up 4% after its VMS Eve suborbital spacecraft completed a test flight after more than 15 months out of action. In summary, investors reacted to the new data showing ongoing inflation pressure and a tight labor market, with the PPI rising by 0.7 in January, exceeding forecasts. Yeah, we already covered that. While some sectors such as consumer discretionary and technology were hit hard, other companies such as Roku and Twilio reported upbeat earnings and were big winners. All right, so that's everything in the daily recap. Let's dive a little deeper into the labor market. U.S. labor market still tight. Monthly producer inflation accelerates. All right. The number of Americans filing new claims for unemployment benefits fell unexpectedly last week, offering more evidence of the economy's resilience despite tighter monetary policy. According to the Labor Department, initial claims for state unemployment benefits slipped 1,000 to a seasonally adjusted 194,000 for the week ending February 11th, whereas economists had forecast 200,000 claims for the latest week. This is despite the high-profile layoffs in the technology sector and in interest rate-sensitive industries. Companies are generally reluctant to lay off workers after experiencing difficulties recruiting during the pandemic, because that was such a big deal. Moreover, data on Thursday showed monthly producer prices increasing by the most in 7 months in January as the cost of energy products surged. Even stripping out energy and other volatile components, underlying producer price inflation rose at its fastest pace since last March. A second report from the Labor Department showed the producer price index final demand rebounded 0.7 in January, the largest increase since June. However, fresh and dry vegetable prices tumbled 33.5%, and excluding food and energy, goods prices shot up 0.6%. The biggest increase in the so-called core goods prices in 8 months, and followed a 0.1% gain in December. Services increased 0.4%, matching December's gain. They were driven by a 1.4% jump in hospital outpatient care, and portfolio management fees also rose, as did airline fares. These data feed into the calculation of the Personal Consumption Expenditures Price Index, one of the key inflation measures tracked by the Fed for monetary policy. With the CPI and PPI data in hand, economists estimate that the core PCE price index rose 0.5% in January after increasing 0.3% in December. In the 12 months through January, the core PCE price index is forecast advancing 4.5% after increasing 4.4% in December. The Fed has a 2% inflation target. The road to low inflation will likely be bumpy, with a survey from the Philadelphia Fed showing a gauge of prices paid for inputs by factories in the Mid-Atlantic region rose for the first time in 10 months in February. That'd probably be January, sorry. Labor Department also showed that the number of people receiving benefits after an initial week of aid, a proxy for hiring, increased 16,000 to 1.696 million during the week ending February 4th. Despite this, labor market resilience is marked by the lowest unemployment rate in more than 53 years. The Fed raised its policy rate by 50. Let's see here. Let me skip down. The policy rate is from near zero to a 4.5 to 4 3/4 range, with the bulk of the increases between May and December, although 2 additional rate hikes at 25 basis points are expected in March and May. And I did read an article, who was it who was talking about this, that they are expecting potentially a 50 basis point or 0.5% rise at the next meeting, which would probably be March. Although 2 additional rate hikes, we covered that. Financial markets are betting on another increase in June. So, all righty. Well, that's everything there. Last up, I have a report that came out from First Trust. Has to do with January housing starts. So let's go ahead and go through my synopsis of this. Housing starts in the U.S. fell for a 5th consecutive month in January, declining 4.5% to a 1.309 million annual rate, below the consensus expected of 1.356 million. Starts are down 21.4% compared to a year ago, with both single-family and multi-unit starts contributing to the decline. Single-family starts are down 27.3% in the past year, while multi-unit starts are down 8.1%. Starts in the Northeast and Midwest declined, while those in the South and West rose. Meanwhile, new building permits increased by 0.1% in January to a 1.339 million annual rate, which is below the consensus expected of 1.35 million. Permits for a single-family home are down 40% compared to a year ago, while permits for multifamily homes are down 3.6%. Slowdown in housing starts is attributed to the lower demand resulting from the surge in mortgage rates since late 2021. This is despite the unusually mild winter weather, which usually encourages new home construction. The rise in 30-year mortgage rates, again, recently implies that the housing market will not experience affordability relief anytime soon. However, rates are still lower than the recent peak, and it appears that the sticker shock of the rapid increase in financing costs last year is wearing off. Improving the future sales outlook from developers. The National Association of Home Builders Housing Index, which measures home builder sentiment, rose to 42 in February from 35 in January, the second consecutive gain after the longest streak of declines since the records began in 1985. An index reading below 50 still signals that more builders view conditions as poor than good, but this data reinforce the view that the housing market is finding its footing in the newer, higher rate environment. Although groundbreaking on new residential projects is down 21.4% from a year ago, construction overall has hardly come to a halt. The number of homes under construction is near the highest level on record back to 1970, demonstrating a slower construction process due to a lack of workers and other supply chain difficulties. Permits for new projects remained essentially unchanged in January, given that builders already have their hands full. All right, so it's bad news, it's good news. You had a lot of people moving around in 2020 and 2021. And so the housing market, really exploded. And then with the hike in interest rates, you've had this, so the previous years, it was way up here. Last year, because of interest rates, came way back down here. So the mean is probably somewhere in the middle. So it's probably not nearly as bad as some of those numbers really reflect. But it is still a tough environment out there, but the housing market is still pretty busy. I just have to look around where I live and around the rest of the country. So inventory is not sitting around forever. So, all right, well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. Hope everyone has a wonderful and fantastical evening, and I'll talk to you next time. Adios.